If a week's a long time in politics, 2 years is an eternity in monetary policy. 2 years ago, at a time of heightened uncertainty, the MPC instituted a comprehensive package of measures, including cutting bank rate to a historic low of 0.25% and purchasing an additional £70 billion of assets. Today, the MPC is raising bank rate by 0.25% to 0.75%. 2 years ago, the UK economy had substantial spare capacity and domestically generated inflation was low. Business confidence had fallen sharply to levels last seen in the wake of the financial crisis. Inflation was expected to overshoot its target, but overshoot it entirely because of the sharp drop in sterling, which itself reflected the view of financial markets that Brexit would bring a large negative shock to UK relative incomes. In these exceptional circumstances, the MPC rightly chose to support jobs and activities while it extended the horizon over which inflation returned to target. That strategy has worked. Today, employment's at a record high. There's very limited spare capacity in the economy. Real wages are picking up, and external price pressures are declining. With domestically generated inflation building and the prospect of excess demand in the economy emerging, a modest tightening of monetary policy is now appropriate to return inflation to its 2% target and to keep it there. UK growth in the second quarter is estimated to have rebounded, as expected, consistent with the MPC's judgment that the slowdown in the first quarter primarily reflected the weather, not the economic climate. Construction output rose in May at its strongest rate in 2 years. Retail sales grew at their fastest pace in 3 years. And broader survey indicators of output growth have been in line with the committee's expectations. In the MPC's latest expectations, conditioned on the gently rising path for interest rates implied by the market yield curve, UK demand is expected to grow at around its current pace. Household consumption is expected to grow at a modest rate, broadly in line with real incomes. With continued support from external demand, limited spare capacity, the relatively high rates of return on capital, and the low cost of finance, business investment is expected to expand at an annual rate of around 3.5% over the forecast period, a subdued pace relative to past recoveries, reflecting the drag from Brexit-related uncertainties. Although trade tensions have increased and global growth has become more uneven, global growth is still projected to remain above trend, supporting UK activity over the next few years. UK exporters remain in a sweet spot, with sterling down 17% in anticipation of a Brexit that has not yet happened. Overall, demand growth is likely to average 1.75% over the forecast, just above the new subdued rate of supply growth. That's more than sufficient to absorb the very limited degree of spare capacity that currently remains in the economy and to move the economy into excess demand by late 2019. Turning to inflation, CPI inflation has fallen back towards the MPC's 2% target since the start of 2018, reaching 2.4% in June. Above target inflation continues to reflect the effects of sterling's past depreciation as well as higher energy prices. The committee's latest inflation projection is a little higher than in May, reflecting the effect of recent rises in energy prices and the 2.5% recent depreciation of sterling. Such external factors could inject some volatility into the path for inflation in the near term. The bigger picture, however, remains one of external cost pressures easing, with the peak impact on inflation from the referendum-related fall in sterling now behind us, and domestic inflationary pressures continuing to build as slack is absorbed. The labor market is strong. Unemployment is at a 42-year low and is projected to fall a little further below the MPC's estimate of its equilibrium rate. Both the employment rate and the number of vacancies are at record highs, and job-to-job flows are back around pre-crisis levels. Pay growth has picked up in recent years as the labor market has tightened and companies have found it harder to recruit and retain staff. Across the economy as a whole, growth in average wages, excluding bonuses, has risen from around 1.75% a year during 2010 to 15 to around 2.5% in 2016, and that wage growth is expected to have picked up a little further to around 2.75% by around the middle of this year. The picture of strengthening pay is corroborated by a range of indicators. The The median pay settlement recorded in the bank's settlement database has risen to around 2.5% this year, after having been steady at around 2% for each of the past 3 years. And survey evidence from our agents suggests that pay settlements will rise further this year. Direct pay indices remain well above their historical averages for both permanent and temporary employees. Although the current rates of pay growth are lower than pre-crisis averages, this largely reflects weak productivity growth. As a result, domestic inflationary pressures are rising, with whole economy unit labor cost growth increasing from 0.5% on average during 2010 to 15 to 1.75% in 2016, and to above 2% most recently. Unit labor cost growth is projected to average 2.25% over the forecast, a rate that is consistent with inflation being at target. In this environment, an ongoing limited and gradual tightening of monetary policy is likely to be required in order to return inflation sustainably to its target at a conventional horizon. In the MPC's central projection, conditioned on a market path for bank rate that incorporates around 3 rate rises over the next 3 years, inflation remains above target at the conventional 2-year horizon. And if bank rate were to remain at its new level of 75 basis points, inflation would be expected to remain above 2% throughout the next 3 years. Now, 2 issues will have a particularly important influence on the setting of monetary policy going forward. And you can guess the first, which is Brexit. It's on the front of the papers and top of the news most days. As has been the case for some time, the MPC's forecast is conditioned on the assumption of a relatively smooth transition to an average of a range of outcomes. This is not a prediction, but a simplifying assumption which broadly reflects how UK businesses and households are behaving. The committee recognizes that the economic outlook could be influenced significantly by the response of those businesses and households and financial markets to developments related to the process of EU withdrawal. And those negotiations are now entering a critical period, with the EU and UK both seeking an agreement by the end of the year. Although the range of potential outcomes is wide, what matters for monetary policy is how people react to these developments and how these reactions affect the balance of supply, demand, and the exchange rate. Thus far, British households have been resilient but not indifferent to Brexit news. Consumer confidence has been little changed in recent months, below its pre-referendum levels, but around its longer-term average. Household spending has been increasing broadly in line with real incomes, though household borrowing for major purchases has slowed and the housing market is subdued. Financial markets, particularly sterling, marked down the UK's relative prospects quickly and sharply. Risk premia on sterling assets have increased somewhat in recent weeks. Since the referendum, business investment has picked up, but businesses have invested much less aggressively than usual in response to an otherwise favorable environment. There are signs that business sentiment is softening again, with references to uncertainty in their conversation with bank agents and policymakers spiking sharply, and concerns about Brexit reported in surveys such as the Deloitte CFO survey, now at their highest level since the referendum. Now, the second issue that will influence monetary policy setting, the equilibrium interest rate, or R star, is as obscure as Brexit is prominent. The equilibrium interest rate is the interest rate that, if the economy starts from a position with no output gap and inflation at target, would sustain output at potential and keep inflation at target. Now, R stars isn't a direct guide to setting a monetary policy. Rather, it's a way to think about the forces acting on the economy and whether policy as a whole is stimulative or contractionary. The appropriate level of bank rate depends not only on the level of R star, but also on the need to close any output gap that might exist, or whether shocks merit varying the horizon over which the MPC seeks to return inflation to target. And as you know, the MPC published today its assessment of the factors influencing R star, or the equilibrium interest rate. And the key messages of that box are: that the level of bank rate consistent with output at potential and inflation at target has fallen significantly from pre-crisis levels. This has been caused by both structural forces, such as productivity and demographics, and shorter-term forces, such as uncertainty and private and public deleveraging. Both of those have pushed the equilibrium rate down further. As a consequence, even though bank rate has been very low, the stance of monetary policy in recent years has been mildly rather than wildly accommodative. Indeed, the facts that today the economy is near full employment and core CPI tells us that the combination, and that core CPI is at 1.9%, tells us that the combination of historically low rates and asset purchases 2 years ago was about right. Tighter policy then would have led to worse outcomes now. The box also provides context to our long-held guidance that rate rises are expected to be limited and gradual. Limited because we think those structural factors that have pushed down on the equilibrium interest rate are likely to persist. And gradual because we think the domestic shorter-term factors, particularly those headwinds from uncertainty and fiscal drag, will fade slowly. As a result, R-star can be expected to rise gradually, and policy needs to walk, not run, to stand still. To conclude, in recent years, the UK has faced a series of supply shocks and regime shifts that have created a set of difficult trade-offs for monetary policy. And Brexit is the most recent and potentially the most important example. But if the economy were to continue to develop broadly in line with these inflation report projections, the MPC judges that an ongoing tightening of monetary policy over the forecast horizon would be appropriate to return inflation sustainably to its 2% target. As was the case before, that judgment relies on the economic data being broadly consistent with the MPC's projections, and it relies on households and businesses and financial markets, how they respond as Brexit progresses. The MPC reminds that any further increases in bank rate are likely to be at a gradual pace and to a limited extent. The bank is well prepared for whatever path the economy takes, including a wide range of potential Brexit outcomes. The UK banking system has sufficient capital to continue lending even through a disorderly cliff-edge Brexit, however unlikely that might be. For cliff-edge Brexit risks that the private financial institutions cannot self-solve, the Bank of England is working with Her Majesty's Treasury to find solutions. Where those issues are cross-border, the bank is working with the ECB to manage them. And the MPC will respond to any persistent change in the outlook to bring inflation sustainably back to target while supporting jobs and activity. That's how we set policy 2 years ago, that's how we're setting it today, and that's how we'll do so in the future.